what I would say is that where's the opportunity today to use skill to build value? And the smartest property investors I know are doing that. They don't buy solutions, they buy problems, they solve the problem, and they refinance or trade out, even better, their profit and go again. Now, if you don't want to do that, if you don't want to put in those extra hard yards because you're busy in your job or whatever the case might be, then you have to play the slow and steady game. You have to wait for the market. And for you, you might have to just do what you can to save as much money as you can to build your capital so that you buy a property every other year or every 2 or 3 years and wait for the market to return back to high five category. But that's not the conditions that we face at the moment. And this is going to be a challenging time for investors. I mean, I wish I could say we just have to sit in the boat and the stream would carry us along. But I think we've got more headwinds than we've got tailwinds for the foreseeable future. And I think things are going to get worse before they get better. But here's what I will say. I've made heaps more money in down markets than I have in up markets. In 2009, when I went to America and bought a couple of hundred properties, I had to pay cash, couldn't borrow money, but I was buying duplexes for $18,000.
Wow. That's
so.
And what was the cash? The cash on that would have been maybe, I don't know, what, $500-600 a month?
900 a month.
Jeez. So they're basically paying
probably half that net. But this is the point. There'll be opportunities, but people will be closed out to the opportunities because they won't be prepared for it. Now, there might be some people frustrated at the moment saying, Steve, you haven't given us the magic bullet to get financially free in 5 years with no effort, no
But it's
work.
there though.
And it's like, it doesn't exist.
Yeah.
Stop trying to get rich easy. You can get rich quick, but I got rich in 5 years, but it requires hard work. And if you don't have those fundamental skills down pat to begin with, it's that much harder again.
Well, you're very good at spotting opportunities. Like with your vendor financing in the first book, you noticed an opportunity with first home buyers, how they were spending more on a mortgage than if they vendor financed it. What are some of the opportunities you're seeing out there in the property markets nowadays?
So what are the opportunities that I see today? The opportunities that I see today are few and far between because the market's overvalued. So I think if you're jumping into the market right now, then you're paying top dollar at the top end of the market. Now, you can still make good money if the market keeps going up and the government keeps finding ways to inflate the property market, and high five and hallelujah if they keep doing it. But I'm not sure that is reliable. Like, we can sit here and we can all hold hands and pray and hope that it will. But let's be strategic. What are the factors that caused property prices to go up? Can you give me one?
I'd say low interest rates.
Low interest rates. Let's go with the easy one. Thank you, Jeff. You get 1 out of 10 for that. But you've got the easy one. You can take that off the list.
I think I know. It depends on how far back we're talking, because another, I think, I don't know how many people think about this, is double
income families.
Yeah. But I told you I'm over 50. I can only deal with one thing at a time. As far as interest rates go, right? So if interest rates are low, interest rates aren't low anymore. So a tailwind has turned into a headwind. Yep. Now, if we can just start stacking up what's going to cause property prices to go up or go down, would you say interest rates are going to cause property prices to go up or go down? Headwind or tailwind?
At the moment, probably more of a headwind.
Headwind, absolutely. People are struggling to afford their mortgage, and interest rates, the RBA governor for everyone came out tonight and said expect interest rates to go higher. Massive headwind. All right. So now let's come to your point, Joe. Double incomes, right? Are incomes going up or going down in real terms?
Well, if you factor in 7% inflation, it's and 3% employment growth. Is it 3% growth on employment? Yeah. So
unemployment, you mean?
Going backwards. So headwind or tailwind? People have more money or less money? Less money. And then we put in inflation, the cost of everything going up. Headwind or tailwind? Headwind. So what's a tailwind for investing? I'm struggling to find one.
I can think of one or two. That depends. The problem is it's quite subjective. Arguably, is immigration. So we're getting more people into the country, which, kind of paints.
Except what, Jeff? They can't afford to buy a home. That's upwards pressure on rents. That's not upwards pressure on prices.
Yeah, but the people that are coming to the country are high skilled migrants that have good, that can earn good incomes and that can afford to buy properties.
And when they go for it, when they go to get a loan, what's the first thing the bank's going to say? Show us your tax return. And they're going to pull their tax return from South Africa or the UK or something else like that. And guess what the bank's going to say? Come and talk to us in 2 years when you've got a couple of years worth of Australian tax returns.
Yeah, if they're a business owner, but if they're an employee, show me 3 months worth of statements, and you've got yourself a loan. And also, what about the supply and demand of property? Where are these people going to live? If we can't, like right now, we've just gone through a very tough building environment where builders have been collapsing and but fewer houses have been built. Where are we going to put these people? And what's that going to do?
Great question. Where are we going to put them? But I see that as a rental market problem, not a property ownership problem. Now, I reckon what you're doing is pointing to what's going to cause the property market to pick up in the next cycle. Immigration, I think you're going to see a lack of building happening. But at the moment, are property prices going up or going down? Property prices, generally speaking, are going down. So if it's harder to borrow money, you need a bigger deposit and harder to borrow money at the moment. You've got prices going down. You've got sentiment and economics going against the property market. Now, Warren Buffett would say invest when people are scared, or whatever he's saying is, be greedy when people are fearful and fearful when people are greedy, right? But I think at the moment, unless you've got skill, it's always a great time to buy a great property if you've got skill. If you're just relying on the market going up, then why would you invest now when the market's going down? Why not just sit out the market, take the risk off the table and jump in later on when prices start going up? You don't need to take the risk.
What about, though, your aversion to, and this is something that came up in the comments when we did this post, your aversion to debt? How do you sort of feel about debt and leverage and all that sort of stuff?
Well, debt's something you get into to get out of. And there's 2 types of debt. There's lifestyle debt and there's financial debt. Lifestyle debt is money you borrow to fund a lifestyle you can't afford. So you need to supplement it. Buying a house to live in. You can't afford the house, so you got to get a dirty, great big mortgage. That mortgage is tapping money you haven't yet earned and spending it now. So you get the house, but then you get the 20-year obligation to keep working. Yeah. Now, I'm anti-lifestyle debt because what it does is it reduces your ability to borrow for financial purposes. So I'm not anti-lifestyle, I'm anti-lifestyle debt. And then the other thing about lifestyle debt is it tends to entrap people into a position where they eventually need their jobs more than their jobs need them. And that to me is super risky. You see people in their 40s get made redundant and struggle to get back into the workforce, 40s and 50s. It's a terrible, terrible situation. People that used to have managerial, higher paying jobs get let off, can't get back into the workforce, long-term unemployed. Pretty crap situation, especially if you've got a negatively geared portfolio. As for borrowing money to buy investments, I think that's perfectly fine so long as you know what you're doing. To me, it's like playing with matches. Some people can play with matches and they're fine. Other people just burn themselves. What you need to do is say, what is my cost of finance? And if your return of investment from an income point of view is lower than your cost of finance, then you're in a dangerous situation because your debt is not self-liquidating. The debt is not going to pay itself out of your investments. So if I'm borrowing at 8% and my return on investment is 2%, my income, then I'm minus 6%. Debt is starting to weigh me down. If I'm borrowing at 6% and my cash flow return is 10%, well, then I'm ahead and the investment is paying itself. Now, I don't mind investments that pay for themselves, but here's the goal, right? The ultimate goal, which is like the gold standard. You want to be on the gold medal podium with your national anthem playing and your flag flying behind you and everyone cheering and, yeah! Then here's what you need to do. Be debt-free. Steve McKnight has no debt at the moment, not a single dollar. So does Steve McKnight give a rat's ass what happens to interest rates for the affordability of his investments?
Doesn't matter.
I have no credit risk because I have no credit. And that's the ultimate spot to be in, right? You don't care what happens to the to interest rates because you're immune to what happens to interest rates. Maybe not from a value point of view. Higher interest rates might mean the value of your property goes down, but if they're positive cash flow, as Uncle Sally says, you can hold through a downturn when you get paid for it. It's the people that aren't getting paid, that lose their job, or the value of their property goes down to below what the mortgage is. They get a call from the bank and says you need to sell your property, who gets screwed over in a downturn. So right now, as investors, what I'd be encouraging people to do is to stress test their property portfolio and say, how much can I tolerate prices going down before I get the call from the bank manager? How much can I tolerate costs going up before I can't afford my property anymore, whether it's interest rates or other costs? And will I sell while the market still might pay me a price, or am I going to take my chances that the market's going to recover? These are real questions that people don't start thinking about until it's too late. You can't invest tomorrow or yesterday. You can only invest today.
So what I'm kind of getting is that residential is a bit of a challenge right now because it's very hard to find with the cost of finance being 6%, it's very hard to get a positive cash flow residential purchase unless you've got a big, bucket of cash that's going into it to take away the debt side of things. So how do we create that big bucket how do we create the bucket to start with? Because, I can have 10, it's just like shares, right? If we're talking about shares, you can grow them. Say you're the best Warren Buffett investor and it's at 20%. If you only have $10,000, 20% is only $12,000. And then next year it's going to compound. But even if you're the best investor in the world, you need to build that asset and capital base. How are we going to do that today? How is it going to happen?
Do it exactly the same way as I did it back in 1999. You pull your finger out and you work 20 years in 5 years, which is what I did. And if you don't want to do that, then don't expect to be financially free in 5 years. So anyone that's looking to make money in the market at the moment does so on the basis that it's likely that generic house prices will be against them. So they will have to, here's your hope, Joe, you have to have a strategy where the value you create is likely to be greater than the value slippage of property prices going down. Now, the thing about median house prices is that it's the middle value. It's not the average value, it's the middle value. So not every house will go down in every market. Some houses will go up in value. And so what you need to do is use your investing skill and expertise to identify the houses that will go up in value. What do they look like? They're the ones that people want to pay more for tomorrow than you'll pay for today. And you need to have a basis and a belief on which that will be. And therefore, you can still buy them with confidence today. But if you're buying the median house in the median suburb with a strategy of closing your eyes and hoping it's going to be worth more tomorrow, then that's a risky strategy, in my opinion, in the current headwinds.
Yeah. I think that's a good kind of summation around it. But also there are markets within markets, right? Like Sydney is going down, but there are pockets in Sydney that are growing. This Melbourne's going down, but
why are they growing? That's the question you've got to ask yourself. Because if you can understand why things are going up when everything else is going down, you then say, where else might that be happening? Maybe you've missed out on that suburb where prices already have gone up, but there'll be another suburb with similar things that will either
within
be
your
poised.
Price range.
Exactly.
Start to see the patterns. It's like when you moved from Victoria over to New Zealand and you started buying, you probably saw similar characteristics to
Yeah, we were buying West Wendouree houses before prices went up when we went to Tokoroa and bought the town in an afternoon. And when I went to America and was buying the same crappy houses for 18 grand, it was like Groundhog Day third time over. You see, you're exactly right, Jeff. You see the patterns and the patterns become predictable.
Yep. And what are some of the tailwinds that you see in some of those markets that are moving up? Like, are there particular tailwinds that we should be looking out for going in there?
Well, I think you nailed them, mate. I think the areas where people are moving to, I don't like first home buyer suburbs as a general rule, and that's because they have to be affordable. And if it's affordable when you buy, it has to be affordable when you sell. So it's got a natural glass ceiling on growth. I prefer the suburbs where people who have money and borrowing ability can effectively exercise their giant borrowing ability and pay more for the property than you will. And I like the idea of buying a property that is the worst house on the best street. I used to teach this principle at the seminars that I ran in. No doubt you guys have heard it. Let's imagine there's two houses side by side. One is worth, I'll keep the numbers simple, $500,000, and it's unrenovated. And it's got the one next door is worth 600 grand and it's renovated. Which one commands the higher rent? The unrenovated one or the renovated one?
Well, the renovated one will command
the renovated
a higher
one, right? Yeah. So you ask most investors which one makes the better investment. They will say the one with the higher rent and looks nicer. Yeah.
Yep.
I say no. I say what we need to do is save that 100 grand, and then in 5 years' time, spend that 100 grand on the reno. Now, which one commands the better price? The one that's just been renovated, or the one with the reno that's 5 years old?
The one that's just been renovated.
As long as the difference, unless that's a $500 a week rent, and your unrenovated one's $100 a week, and then it doesn't. But anyway,
you'll make much more value on the value than the rent. That's something Stu Silver taught me. The aggravation of buying in poor areas isn't worth the extra cash flow for the lost capital growth, and that's been proven I think, in my own investing experience as well. I would have been much better off buying less property in better areas than more property in worse areas, because the aggravation wasn't worth the additional cash flow vis-a-vis the capital growth that we missed out on.
So what are your thoughts on commercial investing, right? So residential, it's not a buy and hope strategy. You can't just buy and hold a property and it's not going to work for you. You need to be a little bit more active, buy problems, get solutions. That's kind of what I've gathered from this conversation. It's like you can't just buy whatever you want and hope and pray that it's going to grow in the next 20 years. You think there's going to be a bit of a lull for the next couple of years, and then there's going to be some opportunities, and then but commercial is that cash flowing machine. Commercial is the cash flow machine that's going to allow you to get to that next level. So is it not? What are your thoughts? I'm seeing a head shake here.
Do you really want me to tell you that the tooth fairy isn't real? Or do you want me to just let you live in hope? You have to understand how these things. You have to understand how these things work, right? Commercial real estate has an implicit risk return of around 8 to 10%. Yep. Commercial real estate at the moment is selling on yields of 4 to 6%.
Yeah.
So how does something that should transact on 8 to 10% get pushed down to 6 to 8%? And the answer is low cost of debt. So if your risk-free margin, if you could go out to the market and borrow at 2% and you can get a 6% return, makes sense to do it, yeah? But if your risk-free rate, because interest rates have gone up, is now 6% and commercial real estate's paying you 6%, what are you getting for the risk you're taking? And the answer is nothing. So in commercial real estate, like the ad said, it's all about the numbers. So the key number is rent divided by price. Mm-hmm. So if my rent's 100, or if my rent's 10, well, we'll say 100 because it's commercial property, bigger dollars. My rent's 100, the value's $1 million. I've got a 10% return, right? If the rent stays 100 grand, the value of the property goes up to 2 million because there's people out there who now want to get into commercial property and bid the price up. So the yield goes down from 10 to 5%. That's great. Then interest rates start going up again. And for the extra risk, the market says I need risk-free rate or beta rate plus 3%. So if my risk-free rate has gone from 2 to 5, the return I need to get has gone from 5 to 8. Does that make sense?
Yep.
Because I need to be paid 300 basis points for the risk of commercial property. Now, if my rent hasn't gone up, the only way of getting an 8% return is, as Jeff has pointed out, what?
Price, you pay a lower price.
Price has to go down. So I can lose a ton of money in value slippage compared to the cash flow of buying commercial property. So the time to buy commercial real estate was when you could buy it at 10. The time to sell it was when you could sell it at 5. Now's the time to hold cash as the market reprices because the risk-free rate has changed. So right now, am I out there buying commercial property on a 5% return? No, because for the risk, it's not worth the return, especially given the risk-free rate now is going up rather than going down. My US fund that I set up, I'm winding that up right now. Write this down. This will be the most important thing I say all night, right? The best time to sell a piece of real estate is when someone wants to buy it. So if I'm able to exit out of a piece of real estate in a headwind at a price that someone is willing to pay and I can bank my profit and I'm happy with the profit, because think about this, if risk is going up, what also needs to go up?
Return.
The return.
Return. If my risk is going up and my return is going down, guess what?
Then
I'm not in a good spot in the market, right? The market's turned against me. I'm not getting paid for my risk. So if you're investing right now and your return is going down and your risk is going up, you're on the wrong side of the equation. So with my US fund, what we did at a board level is we sat down together and I said, guys, here's what I see. I see our risk going up and I see our return going down. And that's a trigger for me to say, let's sell, give the investors back their money, and then wait for the next opportunity and be patient rather than forcing the opportunity.
Yeah. Yeah. Okay. Yeah. You're looking at the spread between the two, between the
yes, I am. But the takeaway is if my risk is going up, do we all agree risk is going up right now? Sure, we agree on that.
Yeah.
I don't think risk is going down. I think we can all say risk is going up. So if my risk is going up and my return is the same or my return is going down, I need to do something because the market is moving against me. I'm taking risk and not getting paid for it, and savvy investors do not do that. So here's what I'd do. I'd ring up and I mean, a phone call's more or less free, right? So I'd ring up the agent and I'd say, hi, I see you've got the property on the market. What can you tell me about it? That's always my standard go-to question. What can you tell me about it? Or what do you want to know? Well, okay, thanks for asking. Why is it on the market? Well, it's on the market because it's just been renovated. Oh, am I right in looking at the photos? Am I right in saying that it's an investor who owns it? Oh, okay. Well, what's the price for cash? Well, what do you mean?
What's the price for cash?
How much can I buy it for today if I sign the contract?
Yeah, that's right. That's exactly what it is. How much for cash? That's Stu Silver taught me that. How much? Because I could put it under a finance contract, but if I just give you a cash offer today, what would buy it? And then
great question.
You start thinking around the lines of, well, okay, now if I bought it and I turned this into this and I did that today, how much do you think I could sell it for? Start asking the agent the value add, and then you start thinking, well, how much do you think it would cost me to do that? And start getting answers to your questions. Build your bank of questions and start getting answers to them.